Good afternoon, everybody. Welcome to Selecting an Option Strategy. I'm Connie Hill. We get together every Tuesday at this time, right at the closing bell, to discuss different option strategies. Now, the last couple of weeks, I've been trying to address some points of pain that some of you have communicated to me. Last week, the focus was on exits. Today, the focus is going to be on understanding assignment that is a risk that you may incur when you're short an option. And we do a lot of short options in this class, short call verticals, short put verticals. And so there's some hesitancy in doing those trades because you don't understand about the assignment. So we're going to talk about that in a little bit more depth here. Hopefully that will give you a little bit more confidence approaching those strategies. Now, I am joined in the chat by Cameron May. Cameron's a good friend, fellow coach. He teaches the Getting Started with Options strategies. So any of the strategies we're going to talk about, he is very familiar with as he teaches that class. If you haven't been to any of Cameron's classes I shouldn't say lately, but if you've maybe skipped over them and you don't understand some strategies, that is a fantastic resource for you to do, is to go and visit either some recordings or attend Cameron's class live. Now, I hope you're following us on X. It's a great way to communicate with us. I am Connie Hill CS. Cameron is Cameron May CS, and we'll post educational content, respond to your questions that you can ask in that forum. That's a great way to be able to do that. Let's go through the disclosures and we'll lay out our agenda here. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and informational purposes only. Don't consider it a recommendation. We will be using the Paper Money software application. It's for educational purposes only. I think it's a great tool and resource to use as you're learning different strategies. I know it's not perfect. It does have some shortcomings, but man, it's a great tool for you. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. Now, today, we're going to review a little bit in our trade portfolio. Always want to look at what the market conditions are, because that kind of sets the stage for what kind of strategies do we think we might want to pursue. Of course, we're going to be looking at a lot of examples here today in our discussion. Now, I'm just going to give you a quick look at some of the different strategies that we'll talk about. And there's a couple of others that aren't really on here, okay? But if you're primarily bullish, you'll probably focus on those kind of strategies. If you're bearish, maybe these. Or if you're slightly bearish or slightly neutral, and you might consider one of these strategies, or you might be completely neutral, okay? Or you're just looking for a big move to offset, like in a straddle. Now let's go take a look at the market, see what they're giving us, what they're looking like right now. So we jump over there. Got the SPX up here, and it looks like it closed here about 0.5%. Which is nice. You guys are probably really familiar with what the SPX looks like on this 6-month chart. The thing that I'm finding interesting personally is that over the last few days, weeks, it's kind of been stuck at a little bit in kind of a consolidating pattern. Not really making new highs, not really making new lows, just kind of wiggling around in there. You know, you did have a little pullback here. If somebody were looking at this as maybe say a flagpole and this being a flag, and there was a breakout here, but just hasn't moved a whole lot. Now, today, it looks like, oh, it's finally moving beyond kind of this short-term consolidation. So we'll see if it continues to do that tomorrow. I've got the MACD on the screen here. Some traders like to consult it so that they can see when does the MACD cross the zero line, because typically they could use that as a potential signal. The other thing we look for here is if it's down on this side that's red, meaning it's crossed over the zero line, and then it is bright red as it's kind of coming down, but then it turns to this darker red color like we see here today when it's starting to shift direction and start shifting momentum. So that could be something that's helpful for you to pay attention to. Let's also look at the NASDAQ. NASDAQ looks like it eked out a bigger gain today, 0.79%. it's kind of been going through the same pattern, just kind of consolidating sideways, maybe waiting for some news. Sometimes that'll happen if the market's waiting for a lot of economic reports or something like that to appear during the week, or if they're waiting for the Fed to speak or what have you. Sometimes we'll see that happen. It too looks like, I don't know if it really closed above this high point here. This high point was, let's see, 21,611. And where did it close? 21,662. So it looks like maybe it just barely closed a little bit higher than where this sideways activity has taken it. I don't know that it looks that convincing because it's not that big of a candle. But, you know, we should watch to see if there's any follow through on it tomorrow. Now, John is asking, are consolidating patterns typical or normal? How long do they typically last? You know, John, it would be nice if we knew what an average was. Is it typical? Yeah, a sideways pattern can be typical. You know, we've kind of had some market direction that has been like purely bullish, purely bearish, and we haven't had a lot of this look in the markets recently. But yeah, it is very common to see that happen with an index or with a stock. And when we see it on the indexes, we're likely to see it on a lot of stocks as well. And I'm going to say there's no typical number of days. You know, I was looking at some patterns earlier today, and, you know, some consolidations went on for like 3 weeks, and there were other consolidations that went on for like 5 days. So it really can vary there. Let's look at the volatility index. And with the volatility index, you're noticing, okay, it's back down here in this 18, 19, 17 range, dropped a little bit here today. It's not as low as it was at the end of last year, but, you know, it's not up in a high range, okay? And so I'd say overall volatility is, generally speaking, a little bit more lower than what it has been in some of these periods of time. So knowing that the market's going a little bit sideways, knowing that the volatility index is staying low, where does that put you as far as your posture goes? I'd like you to chat that in. Are you considering being, do you think you're a little bit more bearish? Do you think you're a little bit more bullish? Do you think you're a little bit more neutral? We could have various opinions in here. Various opinions are just fine. Okay, but go ahead and chat that in. And I'm going to come back here for a moment. While you do that, I just want to look at the Dow Jones, $ DJI. It hasn't been performing quite as well as some of the other indices have been. It too has been kind of in this sideways stalling pattern, but again, that's only 30, although they'll be at very large stocks. Then on the Russell 2000, a small cap index, same thing, just kind of this sideways action. And actually on all of them, the MACD is rolling up just a little bit to that darker color, indicating perhaps we might be seeing a swing of momentum that way. So let me go to your answers here. MP's neutral, David is bullish, Life in the Fast Lane is bullish, Jose is bullish. Yeah, we probably have more things looking like more bullish, but I can see somebody being slightly neutral to slightly bullish, maybe a little bit of a range. And if that's the case, probably aren't really going to focus on these bearish strategies. There could be something in here we might take advantage of, but primarily we might be focusing on these strategies here today. All right. Do we have to pick one of them? No, we don't. And in fact, in this class, we don't. There may be some times when I say, all right, we're going to focus on, say, a call diagonal because we haven't seen much of that for a while. So let's focus all our trades on that. But, you know, there might be some you're saying, I think a long call would be fine there. Somebody maybe really aggressive on something could say, I'm going to do a synthetic stock. I'm going to sell the put, buy the call, and hope that thing rockets up because it's putting on two bullish positions together. Or you might be a little bit more reserved and say, well, I'm just going to put a short put vertical on. Yeah, maybe it's got an uptrend and you just want it to stay above a certain price. Okay, so each strategy has their place, and there could be that you know two of the strategies, and so those are going to be your go-to strategies. There's nothing wrong with that whatsoever. Kevin's bullish. Kelly is neutral. All right, appreciate your feedback on that, you guys. We're going to kind of focus over here on the bullish strategy side. Now, what we're going to do is we are going to look at some of our previous positions. I want to discuss those. I want to kind of have that discussion, and then we're going to move into some new trades. I've got several lined up here I'd like us to take a look at. And at the same time, I want to address this concern that some of you have about not doing something where you're selling an option because you're concerned about what might happen to you if that happens and it doesn't work out the way you want. Okay, we'll look at that on one of our new trades. So let's pop back here to our Thinkorswim platform. And we have a few trades we need to look over. Oh, let me get rid of that. All right, here we go. And these are the trades that we still have going on in our class. Now, we have some covered calls that I want to touch on first. And quite honestly, they worked quite nice. Now, covered calls are not on those strategies, right? From the slides. Yes, the covered calls were not even in there, but yet they can be a legitimate combination, right? An option strategy and a stock strategy. So let's start with GM. And we're going to go through this pretty quickly. On GM, we got into the stock and sold the call at the same time. We did a buy right strategy. We did that on the 21st of May, so about 2 weeks ago. Okay. You're going to notice here on our GM position, we don't have the short call anymore. On our USB position, we don't have the short call anymore either. Well, what happened? Okay. I'm gonna walk you through that. We're going to come out here to GM, and we had sold that call. I marked the day that we got into the trade, and expectation was that it probably was not going to move a whole lot. You can see it just kind of dwindled a little bit, but not really any sharp moves, okay? And I actually need to go mark this on the chart, but what happened was yesterday, our call got to a point that it went ahead and got us out. We said, hey, if we get 80% of these covered call premiums, we're going to get out of the trade. So if we come over here to the monitor and the account statement, here's our GM. Okay, so we got in together selling the 5250 call and buying 100 shares of the stock. We collected 68 cents on that call that we sold. That is kind of helping act as a buffer as the stock dwindles. Okay, and we were able to buy it back for 14 cents. That's what we put in as, okay, if we get that, we've got 80% of it. Let's go buy it back and get out of the trade. And sure enough, that's what it did yesterday. Yeah, yesterday on Monday, it did that for us. Same thing happened here on USB. Got in on the same day. We sold a call. We collected some premium. We said, whatever is 80%, let's go buy it back. And in this case, we collected 45 cents initially. We went and bought it back for 9 cents. Got us out of the trade again. That was yesterday morning. Let's see what USB looks like here a little bit. Very similar to GM in that it didn't move a whole lot. We weren't getting a big gain as far as the price of the stock goes. And that's where that call comes into play as being valuable, because you collect the premium up front, and as it dilly-dallies around here, great. You're just collecting premium on a stock that you're still comfortable holding. Okay, so that's what happened on those two. And you can tell, you know, it was at some point in the morning, maybe the stock came down here a little bit before kind of rallying up, and that's when it executed for us. Now, there's one more that we still have going on, and that's Verizon. So we're going to pull up VZ. And on VZ, we have an order to buy back the short call. You can see it's just a little bit below where the stock went today. So it didn't tap on it. If we come over here to the monitor tab to our activity and positions, and we pull up Verizon, we do have an order in there again to buy it back. If it gets, we get 80% of that credit on the call we sold, we're happy. We're going to take it and run. And then on Verizon here, you can see the whole position's down about 20 bucks, so not a big deal. The price of the stock is down a little bit, what, 20 cents from when we entered the trade. We were able to collect 44 cents on this. Right now, that the value of that call is 15 cents. So it's not quite ready to buy back. Let's see what we have on Verizon here. On Verizon, we have said if it gets down to 9 cents, go buy it back. Right now it's at 15. All right, we're going to just allow it to continue to work. How many of you do use the covered call strategy? I'm going to say kind of regularly, meaning you're comfortable with kind of that strategy overall. I'm just curious. I'd like to have you tell me. The trade that we're going to look at here is ARM Holdings. Now, ARM Holdings, we put on last week on the 28th of May. We've got still 17 days left in the trade. And actually, those options that are short, those that were short of the call options, they were June 20 expiration as well. So right now, this one has 17 days left. And we can see on it, we're down about 320 on the trade. Let's look at the chart, and then I want to come back here to these numbers. So we pull up ARM. And let's kind of zoom in here. It's kind of been upward trending. And when we got in last week, we saw this flag poke. We saw the consolidating flag. We saw pop out here. In fact, we were seeing that closing candle last week. And so we put in an order to get in the next day. The next day, it filled. And then the day after that, it pulled back. Now, something we had talked about is on a flag pattern, if the price of the stock comes back into the consolidating flag, that can be a reason to close it out. Some traders might use that as, hey, this trade isn't working out so much. But as you look at it, it's kind of like it didn't really fall as far back into that area, okay, that it deemed that maybe we should close the trade. In this case, it's just kind of dawdling along. And that short leg that we sold is really helping us out. If we look at the long call here, we paid $7.30 for it, and now it's worth $2.90. If we only had the long call without the hedge leg on it, yeah, we would be not happy campers. We'd be like, oh man, that's even less than 50% of the price of the option. And some traders don't like to on a long option. You know, once it hits 50%, they're kind of like, I'm done. Okay. In our case, we collected $5.35 in the short leg, that 140. Where is the price of that sitting right now? Well, it's sitting at $1.75. So we collected this premium. If we wanted to right now, we could go buy it back and basically lock in a chunk of it. I don't know that it's really at a price point we would want to do that quite yet. I think it's just working for us the way we would want a long vertical to work. Meaning it doesn't move a whole lot yet. We want it to, but it hasn't moved a whole lot yet. It still has time. That gives us a buffer to let the trade still work out. That's what we're going to do. We're going to allow it to still work out. Now, as far as you that said that you do use the covered call strategy, Greg's comfortable with it. MP says, I use it as part of my will strategy, which basically means you sell a put. If you get put the stock, you sell a call against it. And you just do this process over and over. Okay, so excellent. I'm glad that you're familiar with that strategy. Brooke does it all the time. Sharon, Kelly, Kevin, Greg, all of you are, people that utilize that strategy. That's fantastic. I'm happy to see that. Brooke says, it's a great supplement to dividends. So maybe some of you that are holding on to dividend stocks that have options available, yes, then it's nice to be able to, maybe when the stock runs up, it's at resistance, looks like it's going to pull back, boom, sell a call, collect that premium, and you're not obligated to stay in it. All right, so that is the status of our trades. All right, let's move on to new stuff, okay? I'm going to pull up a chart here, and this is a stock off of the NASDAQ 100. MCHP. So Microchip Technology. And we can see on this stock, we've traded it before. We're going to zoom in here. I don't know if we traded it in this class. But we saw kind of the stock pull back, but it's established an uptrend of higher highs, higher lows. Kind of pulled a little equal low right here, which is interesting because we have a gap. And on that gap, many times the bottom of the gap is going to act as support for the stock. And it looks like, it came down, it used it, bounced back up. And then what are we seeing here today? Yeah, some people might say, well, it's breaking out of a short-term consolidation. Some might say, well, maybe it's bouncing off. More than anything, it's breaking out of some short-term consolidation, unless you put the line clear up here. And then I'm going to say it just approached it. But I would be kind of looking on, let's say, the last 6 days that it's breaking out of that range. MACD, what's it doing? It's sloping up, turned from bright red to dark red, letting us know that the momentum was shifting. And it hasn't crossed the zero line yet, but it looks like possibly tomorrow, if it continues to move, that could occur, letting us know, yeah, momentum is really swinging that direction. All right. So some people might use this for a bullish setup. All right, let's go to the trade tab and let's see what we have going on. Many times traders like to use how many days worth of time do many traders like to have when they're either buying a spread or selling a spread? Okay, there's a range that kind of is a sweet spot that many traders like to look for. Do you know what that range is? If you do, say it out loud to your computer screen. Maybe I'll hear you. Yeah, it's about 20 to 40 days is ideal. Sometimes we have to go a little longer, okay, just depending on how the strike prices lay out. Sometimes we might not have weeklies to offer us a choice, or we may see weeklies and there's not a lot of open interest in it. And you guys know I am a stickler for open interest. Yeah, Greg knows, yeah, 30 to 40 days. And actually, instead of 30 to 40, it's going to be like 20 to 40 and 20 to 50. Now, MP says 45 to 60, and that may be a personal preference for you. And it's good to know that, right? Where you personally, maybe you like to have a little bit more time. Okay, but yeah, 20 to 40 days is kind of where things are at. On this stock, you know, July options or June options here, 17 days. So we're kind of past the short end of that window. Sometimes we may find some trades that still work out in that window, and we did that yesterday in one of our classes. But we're going to come out here to the July options that have 45 days. Now, is it bad to do this one with 45 days because it's 5 days longer than maybe the ideal range some traders look for? No, it's not bad at all. However, I went snooping around into the July 3 options. Okay, maybe it wasn't July 3. I thought it was. We might have to go out here. We do, in this case, we do have to go out to July. There's another couple that we're going to look at, a shorter term one, okay? This one, we're going to need the monthlies. But look at this open interest, you guys. Thousands of contracts. Does that not just go, oh, gives you a sigh of relief? You're like, oh, good, there's a lot of contracts out here, because we only want to be a teeny tiny number of the contracts out in the balance of that. You know, some people say, you know, if you can be 2 to 5% or less, the contracts that you're trading in the total, then you're dealing with something that is fairly liquid. If somebody, for example, likes to do 20 contracts at a time, say they probably have a little bit, maybe bigger account, but they would want to see some significant numbers out here. They would probably not be all that comfortable if there were, say, 100 open interest contracts and they wanted to sell 20 or buy 20. In this case, sell 20. So that is a consideration. Now on this one, let's see if these numbers still look pretty decent. I was looking to do a 60 put and a 57.50 hedge leg here. So 60, 57.50. We've got 700 contracts out there. That feels good, right? We don't want to risk more than $1,500 in our example account that we use here, but let's go ahead and queue this up. We're going to say sell this vertical. And right now it's coming in at about 70 cents. So that would be what? Our max theoretical gain. What would be our max theoretical loss? Well, it's going to be 250, the difference in the strike prices minus the credit. And let's just work it out. 2.5 and minus 0.7. Our max theoretical loss is $1.80. So we are willing to risk $1.80 to make 70. Okay. What's the probability on that? If I come down here and let's see here. I think I need to come down a little further. There we go. Selling this 60 leg right now, as of this moment, theoretically has about a 63% chance of expiring out of the money. That's exactly what we want on a short put vertical, right? 60 and higher is where many traders will say, okay, then it's kind of moving into higher probability territory. Now this just has a 31 delta, so it's kind of in the lower range of maybe the deltas we might look for. But given that we have 45 days worth of time, that's all right that it's a lower delta. We're comfortable with that. If you wanted to even have a higher probability and a lower return, you could consider selling the 57.50 and then buying 55 as your hedge leg. There's lots of open interest in these contracts. All right. So on this, I'm going to kind of move this down a little bit here. And I'm going to just come here where there's a little bit of real estate. So if we have a 70-cent credit, and that's going to be our max gain, and we have 180, which could be our theoretical max loss, how many contracts can we do here? Well, if we say 1,500 divided by 180 at max theoretical loss, we could do 8 contracts. Now, you don't have to feel comfortable doing 8 contracts. You don't have to do them all, right? You get to decide what that is, but we were basing that off of being willing to risk in this portfolio $1,500 per trade and not really wanting to do more of that. Now, let's talk about the implication of this, okay? Because this is where we're going to talk about some points of pain, and I'll tell you, I've seen you comment on this in the survey, and which I appreciate you doing, okay? Not only in this class, but another class. I'm like, okay, there's probably a real need for this right now. And so let's talk through it. When we sell this 60 put, we create a potential obligation for ourselves. That potential obligation is to do what? Well, to buy 100 shares of stock, because we're selling one contract there, 100 shares at $60 a head. Well, not a head, we're not counting heads, but it's $60 per contract, okay? Which means theoretically $6,000, okay? But we're putting on this hedge leg, this 57.50. So let's see, the stock right now is at 63. So we're basically saying, hey, we've got $3.84 of leeway before it even gets down to 60, okay? But let's look at the chart here. Let's kind of see where would 60 lie. Now I came in here and put a line that was pretty close to 60, 60.04 to say, okay, visually, what are we seeing here? Yeah, we would want it to stay above 60. What if it came down here below? I should get that. I'm going to mark this number. Is it 57.50? Yeah, let's mark 57.50 on here as well. I'm going to put my mouse there. 57. Oh, I was pretty close the first stab. 57.43. I'm just going to change this to 50. So we have it exactly. Okay. So in an ideal world, we'd want it to close above 60 or get out of the trade while it's still above 60. But if it dipped down lower than that, we've got some protection. Say bad news comes out. Something happens with microchip technology, the CEO does something dumb, or they say, oh, we're forecasting whatever in the next quarter or the next year to break up this uptrend, okay? You know, it definitely could come down below our 57.50 if it had some bad news. Now, the first moment that it goes below our 60 or our 57.50, do we need to be alarmed? Alarmed equals freaking out, or whatever you say these days that's freaking out, okay? Does that mean you should? Well, not necessarily, because even if we're working, say, with this 60, and it goes a little bit below 60, how many contracts are out there? Well, contracts out there are 709, and we've got one contract in this big C. So even if it turned out some contracts had to be assigned, because we're in a big pool, of contracts. Maybe not as likely to hit us, but theoretically, it totally could happen. It could happen at any time. In fact, the stock doesn't even have to go in the money for that. Well, what would happen if, say, you got hit by a bus? Well, that's not a very good scenario. Let's just say you got sick and you were so sick, you totally forgot about your trade here. And you went and you held it through options expiration date. And you didn't do anything. What's going to happen to you? Well, the broker's going to do something to facilitate your trade here. And so what they would be doing, they would assign and exercise both those options, the 60 and the 5750. And you would, in that case, take a max theoretical loss that we have said here is 180 a contract. So is it that painful if you have to take a max loss? Now, nobody wants to take a max loss, and a max loss in a short put vertical strategy could wipe out a bunch of gains. Say you had like 6, 7 gains, profit, and then you take a big loss. Yeah, it could wipe out some of those profits. Okay, so of course we don't want that to happen. But again, you were sick, and that's what happened. Okay, then you take a max loss there. Well, what happens? And I think this is probably what some people are most concerned about is what if it kind of goes between there, between 60 and 5750, and you don't do anything about it? Well, number one, to totally avoid this scenario, some traders will say, I'm not going to hold it that long. I am not going to go into options expiration or the day before still holding on to that trade. And one of the exit rules we talked about last week was making sure you're out of a spread 5 to 10 days before expiration date. Okay, so you start kind of thinking about it, trying to make a plan when you get to 10 days. And as your time frame whittles down, man, be out of the trade. Some traders will say they want to be out of the trade before that window gets really short. Okay, now, told you what happens if it expires about 60. Great, we just kept the credit. We're happy campers. We're going to go look for either another trade or look for a new entry if we like this stock. But say it goes in between, it has a risk that's potential, it's called pin risk, where maybe your 5750 expires out of the money, the 60 expires in the money, and that means you're assigned shares of the stock. Okay, you're assigned and you have to buy 100 shares for $60. And so some people feel a little uncomfortable with that, but say you were put the shares, okay? That would happen typically over the weekend. Come Monday morning, you see the shares sitting in your account. So Monday comes and you could be up on your 60 or your 100 shares at $60. You could be down on it. And I think that's the thing that people worry about is, oh, I'm going to be put the shares, and then it's possible that on Monday when I open it up that maybe the stock gaps down, and that's true. That is a possibility. But if say you have money in your account to have those shares put to you, $6,000, some people will just kind of relax, and they know it's not the end of the world, and they may say, okay, really want to take ownership of the stock, but let's find a favorable exit point. Or if you didn't have money in your account to cover the $60 100 shares at $60 each, suppose you didn't have $60,000, then what happens? Okay, I think that's what scares people too, is what are they going to do to me? Well, they're not going to necessarily do anything to you per se, except notify you, guess what, you've got a margin call. And so your choice is put some money in your account to cover it, or liquidate some other trades to cover it. But if you don't do anything, okay, the broker has to do something. Okay, so then typically, more often than not, but not guaranteed, is that they would liquidate that particular position to free up the cash. Okay, so just kind of go through the worst case scenarios in your mind. If you don't have the cash, how do you try to prevent something like that from happening? Get out of your trade before options expiration. And I'm going to put an exclamation point on that, especially if you're just like couple days out, and especially if the stock hasn't moved well away from your strike prices, and it could end up below 60, above 57.50, or even, lower than 57.50. Okay. If you don't want to close out the position, what's the next thing you could do? You could roll. Okay. Suppose you think, oh, this is still a good trade. I know it's close, but I still kind of believe the stock's bullish here. Then you might say, okay, fine, I'm going to roll those options, which basically mean you're going to go out to another time period. Okay. We've got these options here that are in July. And so that would mean maybe you roll out to August options. If you think this is still can work out for me, I'm going to go ahead, I'm going to sell this again, and it'll offset for maybe, what's happened there while you're not getting a complete max gain on it. Okay. Now I do want to see what kind of questions you have, because that's the point of pain that I wanted to take a look at here. So let's see. Kelly says projected move has more probability of exceeding actual move out 45 days to options expiration. So you might be looking, so these are these options here. Projected move has more of a probability of exceeding the actual move. And that could be, Kelly, that could be. We did not go into the analyze and come over here to the probability analysis, but you could, and you could kind of see what those probabilities are. We won't have time to do that today. Okay. Any questions? Send them in now. Okay. We're going to do this trade. All right. We will go ahead and we're going to do 4 contracts here. Okay. So we'll do half of what we could. If we can get a chunk of that gain, we're getting our hiney out of there. Okay. So 70 cents times, let's go 0.3. So we've got 70%, and 30% is left. That says go buy it back at 21 cents. So we're just going to do a first trigger sequential. We're going to create an opposite order here. We're going to go buy it back at 21 cents. Make it a good till canceled order. If you wanted to, you could also put some additional conditions on it. You could come out here and say, all right, cancel this order if at 7 days out or 10 days out or 5 days out, you wanted it to cancel that order and just get you out of the trade. You could do that, right? You could set in some time parameters using, that would be more for the entry, and then here, cancel the order and then do this. Okay. So want you to be aware of that. We're not going to do that. We're just going to go ahead. We're going to send it in, and we're going to throw this in our option strategies bucket. All right. I have a couple more trades I want to put on because I want to make sure that we're monitoring our trades and having new opportunities to look at, new lessons to learn. So we are going to look at one more stock. But I'm going to ask you a question. I want you to type the answer in the chat. What is the best thing to do as you're coming close to options expiration and you're still in a trade 5 to 10 days out? What could be a potentially good thing for you to do? I want you to chat it in while I pull up this stock. And hopefully you can just chat it in real quick because you know the answer, because I just drilled it in. We're going to look at Micron. Semiconductors are just having a nice recovery, aren't they? Micron is no exception to this. It kind of was stuck in this sideways pattern, just like what we were seeing on the NASDAQ. And today it looks like, you know what? It finally, oops, I didn't draw that very good. It finally broke above this short-term resistance area. Okay. Had some nice volume doing so. Looks like over the MACD, pushed over. All right. Thank you for chatting in the answer. Yes. Exit it. Close it if you've got a profit. Exit the trade. Roll the trade. Do not hold the trade through options expiration if you absolutely want to avoid those scenarios. All right. Excellent. I think you got the message. Okay. So here's Micron. With Micron, we're actually going to use the July 30 options. They are so liquid. They've got 22 in trade, over 22 million trading stock today. So typically that means we're going to find some options that are liquid. Now I'll tell you what I was looking at here. I was looking at buying the 100. Look at that, those thousands of contracts. We love that. The ones in between have not been out as long, and so they don't have as much. Okay, so we're going to buy the 100 and sell the 105. We're going to do a long vertical here. So let's bring this out. So 105, and I kind of want to show you this because you might not have, if you blinked, you probably didn't see it. Our 105 strike price here. Today had a lot of contracts going out there in the volume, 1286. Okay, so there's lots of activity out here. We are willing in this case. We have a $5 spread, and we have a maximum potential loss of $235. So what's our theoretical max gain? $5 minus 235. So that should be what? 265, right? So I'm just going to type in our 265 there. The max gain actually is a little bit more than 100%, right? We could possibly make 265 and with our payment of 235. However, we're not going to wait, right? We are going to get out early if we get a chunk. All right. Let's see, 235 in our $1,500 account. Let's see how much we could risk here. If we have 1,500 divided by our 235, says we could do 6 contracts. We're going to do it. We're going to do 6 contracts here. We definitely need the stock to move. Okay. How far? Well, it's a 102.35 right now. We want it to go beyond 105. We've got 30 days for it to happen. Okay, so this is what we're looking at here. We're going to do a first trigger sequential, and then the math on the chunk of the max gain is different on a long vertical than a short vertical. Okay, so on a long vertical, if our max theoretical gain is 265, and we're happy to get out if we get, let's do the 70% again. I'm going to multiply it by 0.7. And so we would be happy, and we'd actually be tickled pink if we got that majority. So we're going to add 185 to 2.35. Well, I'll just do it in, well, I missed the little decimal there. Okay. Let's see if this will keep the number in there. So we'll go 185 plus 2.35. That says, all right, when the debit gets up to about 420, go buy it back. So same first trigger sequential, create an opposite order. We're going to put it in here for $4.20. We'll be happy campers if we get it. We'll be happy to take our profit, move on, go find a new trade. Okay, let's go ahead. We're going to put this in our option strategies bucket as well. All right, so to summarize, we just put on a long vertical trade. Spent quite a bit of time on a new trade for microchip. We did a short put vertical, and we talked through things that are kind of concerning to people when they're first learning about short verticals. And I'm like, man, am I going to create a big problem for myself if I have this potential obligation? And really, you just work through the numbers. You write it down. You see what would happen. You see if you have cash in your account to cover it. And if you don't, then you know, okay, I've got to maybe liquidate the position in order to clear up that deficit. Okay, so you do that in paper money, and you have some scenarios with it. The one thing you have to be aware of in paper money, it does not assign early. So it might give you a false sense of security that you're not going to get assigned. And in reality, in a live market, it doesn't even have to be in the money, although usually it is. But at any time after we sell it, there is always that potential obligation. So just practice it and know in paper money, it won't assign you early. Okay. You'll go, oh, it's in the money. Okay. I'm going to recognize it's in the money and kind of watch it, right? With that. Very good. You guys did well. Anita says, check the profit percentage. Okay. We'll do it real quick and then we'll close shop. Okay, so we are willing to risk, let's see, 265, our theoretical gain, divide that by 2.35. So it's about 112% if we were to go for the max gain on that. All right, so very good. Well, you guys, I did not see a survey today. So one, I hope you are a subscriber. It makes it so much easier to find our information, to find our classes. I'm just going to poke out here. When you have subscribed, you get to see our watch list. You see what's coming up next. We're in our selecting an option strategy. It's the last class of the day. We'll start again tomorrow. Trader Talks, you can join from here. You can see some of the most popular ones. I'm going to point out this one. Cameron and I both actually have some classes in this. Start here using the Thinkorswim platform. Lots of you are still kind of coming up to speed on it. So these are some very short videos to help you get more comfortable with the platform. Okay. If you thought this was helpful today, go ahead, hit the like button. That'll steer other people to it in the YouTube algorithm. And follow Cameron or I. We'd love to interact with you on X. All right, you guys, that's it for the day. Have a great evening. We'll see you bright and early at the opening bell tomorrow morning. Thanks, everyone. Bye-bye.